Okay. Standard disclaimer. Read it at your own risk. That is me. I think that's a fairly old picture since I'm pretty much all gray. But as of right now, the easiest way to reach me is either of those email addresses. I check both my gray and my personal email addresses periodically during the course of the day. You can call me on my cell phone. I don't guarantee that I'm going to answer it. This is what we call our travel season. So we're leaving again on Saturday for traveling down the Caribbean. So I won't be able to be reached on my cell phone, but I do have internet access, so I will check my email a couple of times a day. So if you have questions, please just go ahead and ask whatever it is you have. You can't do that when I'm on it. All right, these are my rules. Rule number one, I will try and not be political during my speaking. I don't think that's appropriate for someone that is moderating or leading a discussion. The questions that you ask, you can be reasonably political as long as it's reasonably polite, and I will try and accommodate you. And no question is unimportant. Ask it as we go along. Makes a lot more sense. I'm turning off my phone since we had a party here last night for about 25 people, and they're thanking us and so on. Ask questions to go. Don't hold on. Don't wait until the end. If it's something that I want to cover, I will say so. If not, I'll answer it as we go along. If there's something that you think is important that we don't cover, go ahead and ask. Once again, this is kind of a 25-cent tour of a $5 issue. So we'll go forward. Okay, why are we doing this now? Why not just wait until the end of the year? First thing you have to understand is this is not just math. This is not just a year-end calculation. There are things that should be considered or done early in the year to maximize what this benefit is. This is a major, major benefit. I strongly believe that for many people, it is important to address what is in your partnership, LLC, and S-Corp agreement. Is it too late? It's never too late to do this. I would do it sooner, not later, but I would not wait till the end of the year or the beginning of next year in order to make whatever changes you want to make based upon what we're doing. Those of you that know me and have heard me speak over the last 30 or so years or more, I believe that tax-free money is something that should always be considered and maximized. I do not believe in tax fraud. I believe that proper tax planning beats tax fraud every day. And this is tax-free money. This is something that you must consider and you must take advantage of. All right. Complexity, complexity, complexity. This is one of the most complicated pieces of legislation and tax areas that we've seen in a long, long time. Even worse than that, I am a vociferous reader of tax information, and basically what has happened here is there's a tremendous, tremendous amount of bad information there. Be very, very careful of what you read, who says it. You know, the old saying of it, just because the internet says it doesn't make it true, is absolutely true in this situation. So be really, really careful. All right, choice of entity. One of the questions that I have been getting quite a bit is, okay, C Corps have a 21% flat tax. Emphasize flat tax. There is no graduated tax. Right? So everything is taxed at 21%. Please understand, there are reasons to be a C Corp, but long ago in a galaxy far away, back in 1986, we lost the ability when a C Corp is sold in order to avoid double taxation. Whenever somebody tells me they're going to convert to a C Corp, I say, you must promise me that you are not going to sell this for X number of years. If you cannot make that promise, don't talk to me about C Corps. There's a lot of stuff that we can do in order to avoid the issues that are involved there. This all gets into choice of entity, choice of entity, choice of entity, choice of entity. I must have talked to 35 or 40 people in the last month that have called me regarding choice of entity. It is a major question whether you want to be an S Corp, a C Corp, an LLC tax as a partnership, a general partnership, a limited partnership, trust, all kinds of things. There's a place for everything. However, you must take a long, hard look at what it is and understand that choice of entity very often, at least in the short term, which can be 5 to 10 years, is a one-way street. Really got to take a long, hard look at what kind of entity you are and who owns that entity and what you're going to do about it. Okay. I am going to present to you based upon the committee reports, legislative history, and the proposed regulations. Underscore the word proposed regulations. Proposed regulations mean that this is what the IRS currently thinks. It does not mean that they're not going to change their mind. Could you turn that off? Turn off the water, please. All right. This means that you can do what you want as long as it's reasonable. This is what they think is going to happen. General rule is 20% of taxpayers' qualified business income is going to get 20% off. Qualified business income means the net amount of income, gain, deduction, and loss with respect to a trade or business. One of the biggest questions that I have been getting is, where is this determined? The answer is, it's determined at the taxpayer level. So that if we're talking about an S Corp, it is talked about at the shareholder level, for example. This is what has to be done. Lots and lots of consideration, lots and lots of things that you have to think about. Next question I have, and this came as a little bit of a surprise, is that it doesn't matter whether you're active or passive, and we all remember going back to the question of active passive determinations and all the questions that are involved in that situation. It doesn't matter whether you're active, it doesn't matter whether you're passive. All that matters is how much you make, and we're going to talk about that as we move along. What trade or business? Any trade or business except for those specific trades or business, which we're going to talk about later, which really comes down to personal service types of entities. And we'll talk about what the IRS has kind of suggested, and they have been really generous in what they've said. Okay. And this is really important to a lot of us that are invested in real estate investment trust, REITs, and comes back to what we think is going to happen with regard to real estate. And basically what it says is that 20% of the aggregate amount of qualified REIT dividends and qualified publicly traded partnership income qualifies. And basically that's important because it gives us a big hint, and we'll talk about real estate, specifically triple net leases, in a little while. But We'll talk about what this does and what this means. It's really, really important to understand what this means as far as real estate is concerned. Capital gains, business, basically any type of portfolio income, dividends from IBM, sale of General Motors stock, any of those things, interest from your savings accounts, interest from your CDs are generally not included in this. All your portfolio income, everything else is excluded, is not considered business income. Let's talk about a triple net lease, all right? Those of you that are in the real estate industry know what a triple net lease is. Basically, this means I built a building, I gave it to you, you're responsible for everything else. The way it stands as of now, if there is a triple net lease, then unless it's to a related party, meaning I built a building and I, the people that own the building, are leasing it to a business, an operating business that I run. If that is the case, then the triple net lease will apply. The only other time is that if it applies as Section 162, which is a business, which basically means that you're somehow involved in to a material amount, which means basically 500 hours you are doing in that building. So that is what's involved. Other than that, if you have a triple net lease, it does not apply. So what am I suggesting? And I've discussed this with several real estate people over the last 2 or 3 days. You have to go and change the lease, assuming that the people you're leasing to apply. You've got to change the lease, so you're paying the real estate taxes. You pay the real estate taxes. However, what you've done is increase the amount of the rent. Will this fly? I don't know, but at least you've done something in order to make this try and work. We now get to something that is very, very important, and this is where the math gets funky, and that is employee compensation of S-Corp shareholders and guaranteed payments for services to a partner / LLC member are excluded from the calculation. And let's see what this means. But before that, I want to talk about S-Corps and C-Corps for that matter, but specifically in this case, S-Corps. All corporations are required to pay all employees, including shareholder employees, reasonable compensation. Okay. What is reasonable compensation? Reasonable compensation first started long, long ago with Judge Porter Stewart. And reasonable compensation is the same thing as pornography. I know it when I see it. What is unreasonable compensation? Same thing applies. This comes back to my comment of, with S-Corps, should an S-Corp specifically identify in the corporation documents how much a shareholder employee's salary should be and why it is reasonable? And I believe it should, because basically if you have designated how much they should make and why it is a reasonable amount, that means the IRS has to attack that and disprove it. Otherwise, you're going to have to come along when the IRS says this is not reasonable, and you're now going to have to demonstrate why it is. I think it's a much stronger position to have everything in the operating agreement in order to do it that way. And that's what I have been advising people. Guaranteed payments to partners and members of LLCs. This is really interesting, and I don't want to get into all of the tax law that surrounds this and everything else. That's an entirely different conference call or whatever. But basically what people have done over the course of the last X number of years, 18, 19, 20 years, that people have been using LLCs and members of LLCs, what they've been doing is they've been using the amount of guaranteed payments in order to minimize the amount of self-employment taxes. Does it work? It does. Just a minute here. I took a seminar with Lou Gauthier, who is a good friend of mine, on this, and he said there is a tax court case that would give you a leg to stand on to include triple net leases in the calculation for the 20%? Any thoughts? And the answer is, it depends. And I know Lou, and I've spoken to Lou, and it depends on when this has been said. The regulations are pretty specific in this area in what they say. And unfortunately, what they say is still open for consideration. If you think you want to go and say, okay, I'm going to do this, and I'm going to rely on a tax court case, you're going to wind up having to defend that, not to an agent, maybe to appeals, but more likely to tax court. I think I prefer my methodology, which is to change the lease document, assuming you can. If you can't, you go with what you have to go with. That's just my opinion. I understand what he's saying. You know, relying on one old tax court case for something that came down now, maybe, maybe not. It's not what is intended in the regulations. But, you know, we don't know. But I like playing things safe. Why is this not moving? All right, let's take a quick example. All right, a business has $250,000 of business income. There's a sole proprietorship, husband and wife LLC, taxes a partnership, and a single shareholder S Corp with reasonable compensation of $100,000. All married, filing jointly. Okay. So basically, as a proprietorship, there is no shareholder salary. There is no guarantee payment. There is nothing, because it's a proprietorship. The business income is the same as the QBI. 20% is $50,000. The partnership has paid no guaranteed payment. Same $50,000. The S Corp, on the other hand, has reasonable compensation of $100,000. Therefore, the QBI is $150,000, and the exemption amount is only $30,000. Okay, everyone happy? No, no one is happy, because basically what we have here is a situation where form overruled substance. Let me repeat that. Form has overruled substance. That's not a new and different problem. It happens all the time in the tax area, but you have to be very cognizant of it. And we're going to see this issue of form overruling substance as we talk about this in all kinds of different scenarios. Example number 2. A business has $250,000, except in this case, there's guaranteed payment of $100,000 and a reasonable compensation of $100,000. So now what we have is the proprietorship wins over the partnership, LLC, or S Corp. So the question now becomes, and again, I don't want to get into this, how much do you have to pay, if anything, for a partnership / LLC member? Is there a requirement that there be reasonable compensation? I'm aware of all the court cases. I'm aware how to do it. Over the last 18 years, I have worked with, I counted them last night, 28 different entities that have this situation, and because it was structured reasonably, properly, with consideration to the old proposed regs that go back over 20 years, we didn't have a problem. And as soon as the agent said this, we said, blah, 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 show me, and they can't. They whip out the cases and we say, it doesn't apply. We have this, they have that, not the same thing, and we win all the time. But again, that is because of the way things are structured. And once again, unfortunately, we have form overruling substance. Phase outs are very important here, and the phase out is interestingly enough done not at the QBI level, but at the taxable income of the taxpayer level. So basically what we have is that if the taxable income of the taxpayer is $150,000, $500,000, or $315,000 marriage filing jointly, that's when the phase outs happen. And it phases in and phases out, as you can see, over $50,000 or $100,000. What is interesting here, and you know, if you've heard me speak before, I'm really upset when there is a marriage penalty. There is no marriage penalty here. Basically, it is straightforward double for married filing jointly compared to single. When you exceed the threshold, all right, now you have to stop and listen very, very carefully to this math. You get the lesser of 20% of the QBI or the greater of 50% of wages or 25% of wages or 2.5% of the unadjusted basis of property immediately after the acquisition of qualified property. Which means that we have massive, massive situations where this is complicated math when you exceed the threshold. The threshold is not that low for a lot of business people, so you really have to take this into consideration, especially people that are in business, and take a long, hard look when we talk about people in the real estate business and we talk about only 2.5% of unadjusted basis. All right, that's not a lot of money we're talking about here. Personal service entities that we're talking about, all the personal service entities, health, law, consulting, athletics, financial services, brokerage, or any trade or business based on personal reputation. Now, what is really important in the regulations is the IRS has really been very generous here with the definition of personal reputation. So when we first saw this, for example, we saw that many people believed that a real estate agent was a personal service business. They came along and said they're not. So basically, this is much more wide open than we thought it was going to be. But once again, these are only proposed regulations. We'll have to see what happens. We've been promised more detailed regulations in the first quarter of the year. Not sure that's going to happen, but we're going to keep track of it. All right. What qualifies? It's any held by and used in a qualified trade or business, which comes back to the definition. I mean, obviously, real trade or business is fine. This comes back in the real estate area to, does a triple net lease apply as a qualified trade or business? And I know what some people say. I know what other people say. I like to try and avoid having to put friends and former clients and everything else going to court. I much rather find a way around that, which is kind of what I have suggested to you. However, it has to be used at any point during the year in the production of qualified business, which is not a problem, and the depreciation does not end before the end of the year, which, you know, doesn't really affect many situations. Okay. Hang on. Saying for 100% shareholders, here's our QBI is calculated off the net flow through business income minus the shareholder salary. Yeah, the answer to that is yes. That's what I just said. So for example, somebody's saying, let's suppose that I have an S corp, and the S corp earns $250,000. You pay salary of $100,000. QBI 250,000 minus 100,000 is 150,000. If this had been an LLC, where reasonable comp doesn't apply, all of a sudden we have an entirely different situation. Again, very, very complicated. Does it make sense? No. But is that the rule as it stands today? Yes. So we don't know where that's going to come down. Okay. Tom owns commercial real estate and has a management company to run it with no payroll. He has income of $1.5 million and an unadjusted basis in the property is $2 million. So the deduction is the lesser of $300,000, 20% of $1.5 million, or 5,000, 2.5% of $2 million. The answer is $5,000, no payroll. Now, later on, we're going to talk about the question of management companies, and we're going to talk about the question of aggregation. So in this case, and I'm really jumping a gun here, but let's suppose that the management company is an S Corp, and we pay the management company, so the management company has part of that income, and he pays, I don't know, let's suppose that he pays $100,000 in payroll to himself. All right. So all of a sudden, because he's above the limit, and we talked about this, and I didn't include it, but $100,000, we now have a whole different calculation that's going to be in, that he's going to wind up having. So that's something that we have to talk about. I didn't include it. It just totally causes issues. The question of aggregation, we'll talk about very briefly at the end. It's in the regulation. It's just incredibly complicated. And I didn't have time to really include the situation. But if you have a situation like that, you absolutely have to talk to your tax advisors or give me a call, and I'll see if I can help you. But you really have to take a look. I spoke to one person yesterday about what to do with these things, and there are all kinds of things that you have to talk about when you have these situations. Laura owns a printing company. She has income of $500,000 and payroll of $160,000. She buys a new machine for $100,000 and replaced all old equipment. First question. She's the sole proprietor of a printing company. Is this reputation the generation of her wealth and therefore excluded? Based upon the proposed regulations, my answer is no. Hang on. Oh, somebody said I blew the math. 2.5% of $2 million is $50,000. I may be right. I'll have to check my math. That'll teach me to do it in my head. I think he's right. Okay, I blew the math. I'm sorry. And the answer is I do not think she does. So I have to change that. I have $100,000, right? Because 20% of $500,000 exceeds the threshold. I have $42,000 because 25% of $160,000, which is the payroll, plus 2.5% of $100,000. I did get that one right. Or $80,000 because the $80,000 is 50% of the $160,000. So basically, if you go back to the beginning, all right, and this is a lesser of number two is the number one says I exceed the two on the bottom, but the two on the bottom I get to take the greater of, and the math is just brutal. Example number 3. A business has $600,000 of business income. Sole proprietor, husband and wife LLC, taxes a partnership, and a husband and wife shareholders in S Corp, which the wife has reasonable compensation of $60,000 in the S Corp and a similar guarantee in the LLC. Other payroll is $50,000 and they have equipment of $100,000. This one is truly strange. So what happens in this case, all right, and the math here works against you. So that basically the whole issue here becomes payroll. So that in this case, because a guaranteed payment in a partnership is not considered payroll, contrary to what other people say, a partner in a partnership, a member of an LLC, taxed as a partnership, cannot receive salary. All right, it's a guaranteed payment. Guaranteed payments do not count as salary. So in this case, what I wind up having is I get the extra $30,000 because the shareholder salary of $60,000, I get 50% of it. Does any of this make sense? No, this does not make sense. This is an absolute classic, again, form over substance. This is something that a lot of us have spoken to the IRS about. They understand the issue, and the problem that they have is legislative. The way this was drafted, they have no out here. Will there be a Technical Corrections Act to correct this and other things? We don't know. We especially don't know now that we have a divided Congress. And you're sitting here and the smoke is coming out of your ears because you're saying, this cannot possibly be right. And the answer is, it is right. All right, somebody said, I have an investment management company, is an S Corp sole shareholder, files a joint return, taxable income is less than. All right. I have an investment management company, so I am managing investments. So the question I have to ask this person is, am I being paid a management fee to manage other people's assets? In which case, in that case, then basically it works because I'm below the limit and I am in the financial management position. If on the other hand, I am managing my own things and everything that is in there is interest and dividends, which is paid out, then the answer is no, because interest and dividends and capital gains don't count. I hope that answers your question. If not, give me a follow-up for that, because the question is, what do we have? As an S Corp owner, wages are included in the wage limitation calculation? And the answer is yes. All right, amazingly enough, it is a deduction when you talk about just the 20%. Then when we take those bottom two in that little slide, all of a sudden we're now including it because it is indeed wages. And again, the guaranteed payments are not wages and it doesn't count. So that basically, does any of this make sense? And the answer is probably not. This is why I believe you must talk to your tax advisors, talk to people what you can and cannot do about maximizing this, and don't wait until after year end because it may be too late to restructure things. That's my comment. Move slide. Optional aggregation, all right? And again, as I mentioned before, this is a situation where if you have real estate on one side, all right, and you have a management company that is managing your real estate on another side, this may make sense to bring the stuff in and have an S Corp management company in order to pay salary, in order to accomplish certain things. All right, optional aggregation. Excuse me. A, ownership has to be 50% or more of both entities. 2 or more of the following have to exist. And I understand how complicated this is. This is why you have to have somebody that really understands all this. The same or offered business together. So basically what you can have is either horizontal or vertical business. Vertical business basically means, for example, one entity makes the raw materials, sells it to another entity, which either does more to it or sells it out. That's a vertical business. A horizontal business is much more, for example, of I own the real estate, all right, same people own the operating business, and that would bring those together. That's the same type of business. I have centralized business elements, which means I have the same people managing businesses, or coordination or reliance, both of which I talked about as your horizontal or vertical reliance. So basically, if this exists, do I want to do optional aggregation? And the other thing that I want to make sure of in the optional aggregation is, does it make sense to do this? Does it make sense to do it, and how do I want to do it? What do I want to do about payroll? What type of entities do I want to have? All of these things should be discussed before year end, which means you've got to do it now. Right? Okay. You have 3 unrelated businesses, okay, with net profit on 2 and a big loss in the 3rd. Do all 3 business? No, they're calculated separately. All right. Each entity is calculated separately, and you know whether how you're netting and what the carry forwards are, and how long the carry forwards go forward, and everything else just gets very, very complicated. This is another situation where in order to take advantage of this, and maybe what you want to do is bring some things together and pass things back and forth through a management company or so other type of company, through an optional aggregation. In order to avoid carry forward, you have to take a look at income this year, future income, and all kinds of other things in between. Once again, you've got to sit down, and you should not be doing this after year end. You should be doing this before year end. Is aggregation a yearly determination? No. Aggregation is, once you have elected aggregation, you are stuck with aggregation. Only way you can break it is with permission from the IRS. That is currently what they say. Because aggregation was not legislative, it's regulatory. A lot of people feel this is going to change, but we don't know, and that's the way the regulations currently read. All right. I don't want to get into required segregation, but basically think of it this way. What people were doing is, in order to avoid certain things, they were creating anti-abuse situations where, for example, the one that immediately fell apart was a law firm that tried to say, okay, we're a law firm, but we're going to bring in all this other business that's over here that we've never included before, even though it doesn't really apply to my law firm, which means it didn't fit. So all the anti-abuse rules just say, if it looks like a duck and quacks like a duck, it probably is a duck. Okay, can you start aggregation the second year? And the answer to that is, as it stands now, the answer is probably yes. I'm not sure why you want to do that and what you want to do, but that's something that you have to look at. Yes, you can make that election theoretically going forward. I've gotten a lot of questions about whether or not it makes sense to do married filing separately, where, for example, one spouse has a lot of income and the other spouse does not have a lot of income, but they have business income, and therefore they can fit under the lower threshold and get a better result than they could otherwise. I hate married filing separately. I hate it on a philosophical way, not a tax way. You really got to sit down and go through all the machinations, all the things that are involved. You know, if you're still going to be itemizing deductions, and whether or not you qualify for itemized deductions, and but you're doing anything with that is something we can talk about totally separately. Once again, this is something that you should not be talking about after year end. All of this planning should be done now. Major warning. included in the legislation is that if you do something in this provision and it turns out that you have a substantial understatement, the penalty here is not based on it. It's 5% instead of 10% of your tax, which is a little bit of a break. But the other thing they're doing is they're going to look at this very, very, very hard when they know what's going on. I covered this in 45 minutes, which is kind of what I wanted. I'm hoping for more questions. If there aren't, I'll let everybody go. You know how to get a hold of me. That's all my criteria. And, you know, if you have questions, please let me know. I strongly, strongly advise everyone to sit down and meet with their tax advisors sooner, not later. Figure out what you want to do with this, what you can do with this, whether aggregation makes sense, what you want to do with triple net leases for those of you that are involved in real estate. I understand what Lou Gauthier is saying. You know, the question is, you know, do you want to sit here and say, well, I have this tax court case that says that, and the IRS is going to say, well, we don't think it does, and all of a sudden you have to go to appeals, and appeals is going to say, well, we think you should be the test case, and you're going to wind up going to court. I hate to, I don't do court, I'm not an attorney, but I hate going to court, and I really advise avoiding court if you can by simply changing the rules as you go along. So I don't see any more questions. Wait a minute. If a business has two lines of revenue, consulting income and equipment sales, can you bifurcate? All right, and the answer to that is, can you bifurcate within a business? And the answer is, no, you cannot bifurcate within the business. You might want to consider spinning off. But the other thing, and I didn't want to get into it because it just totally adds to the total confusion, there are de minimis rules. So that basically, if you have two lines of business, one which would qualify and the other one doesn't, simplistically, it depends which one is more dominant with the sales and income and everything else. And there are very specific de minimis rules. And whoever asked that question, you know, if you email me, I will, you know, send you a copy of those de minimis rules, or you can get them from the office, whichever you'd like. Are there any other tiered partnerships? Oh my God. Do the payroll factor or the assets factor move up or through the pass-through? So a tiered partnership, in a tiered partnership, basically everything is going to pass all the way up to the ultimate taxpayer, since in a tiered partnership, the partnerships are not taxpayers. So therefore the calculation, since it has to be done at the ultimate taxpayer level, my answer is that it would pass up and down through a tiered partnership. I think I got all the questions. Go back to the top here. Took a seminar with Lou. Okay, I covered that. I like to stand on triple net lease. I mean, You know, my problem, this is my problem with the triple net lease. And as soon as somebody says, I have a leg to stand on, I don't like having a leg to stand on. I like having a more than a leg to stand on. And if I can do something so that I have a stronger position, I'm going to do it. And that's my comment about triple net leases, is that you should be able to do more than have that. Please confirm your savings. I think I've got all of them. If I missed something, please ask it again. Oh, you don't understand how I got the 55,000. All right, if you understand how I got the 25,000, all right, let's see if I can get back to that slide. Okay, so you understand how I got to the 25,000. Basically, what happens here, simplistically, is that I've got 50% of the 50,000, which is the 25,000 for the others. The increase of $30,000 is really simple. I have 50% of $60,000, which is the additional $30,000. So you know that's the way it works. And does any of that make sense when the guaranteed payment, which is sort of like salary, doesn't apply? Oh, and again, form over substance. I think that's everything. Okay.